Alright, we're back in chapter 12 on part 3 of this presentation. We're going to start here on slide 50 because slide 49 was just kind of a wrap-up of what we had already discussed. We have a review question here, which is an example of a cash flow from an investing activity. And hopefully by now, answer C should jump out at you, the receipt of cash from the sale of equipment. Since the equipment was an asset the company invested in to make money. Receipt of cash from issuing bonds payable is a financing activity. Payment of cash to repurchase stock is a financing activity. And payment of cash to suppliers for inventory is an operating activity. Moving to slide 51, free cash flow is a term used for the cash that is available for use after subtracting capital expenditures and dividends from the net cash provided from operating activities. So again, a new term. We're not going to really spend a heck of a lot of time on that. I'm not going to promise I won't quiz you or test you on it, but it's not going to necessarily be up there high on the priority list. There's just too much else ground to cover here. Slide 52, here's an illustration showing how the appropriate figures to compute free cash flow can be plucked from the statement of cash flows, namely the three items identified on the previous slide. This illustration shows that Microsoft had a free cash flow of about $11.5 billion. That's pretty huge, even for Microsoft. So again, it's the cash provided by operating activities, less expenditures on PP&E, and less dividends paid. On slide 53, now we move to some measures of performance involving cash. The current cash debt coverage ratio measures how close current cash provided by operations comes to covering the average current liabilities. In the cases of Microsoft and Oracle, two IT giants, it should not be surprising that their ratios are pretty strong. As the slide notes, values below 0.40 times for this ratio may be cause for concern and should be looked into. On slide 54, the cash debt coverage ratio also uses the cash provided by operations as its numerator, but uses the average total liabilities, both current and non-current, as the denominator. This means that we cannot expect this ratio to be as high as the current cash debt coverage ratio, which is measured against average current liabilities. In fact, both Microsoft and Oracle's ratios are considerably smaller than their current cash debt coverage ratios. However, both are still above the recommended 0.20 minimum in this case. Note that the comparison here with the debt to total assets ratio, whereas the current cash debt coverage ratio was compared to the current ratio. On slide 55, as we move into a discussion of the direct method of preparing the statement of cash flows. Although this area will not be covered to the extent the indirect method will be on quizzes and exams, you should still understand the method and rationale for putting this statement of cash flows together in this manner. In fact, in the homework, I don't believe I'm assigning anything except for an extra credit problem that involves preparing a statement of cash flows using the direct method. It simply is not used that much, so I'm not going to emphasize it all that much either. But I think it's worth taking a look so that you can see how this one is done and what the differences are with the indirect. So this method takes more work because we need to adjust each item in the income statement from the accrual to the cash basis. Therefore, net income is not used as a starting point as it is with the indirect method. Then the major classes of cash receipts and cash payments are compared, and the difference is the net cash provided by operating activities. On slide 56, here's a pictorial showing the main components of cash receipts and cash payments that go into determining the net cash provided by operating activities under the direct method. And on slide 57, again, we use the comparative balance sheets to determine the increases or decreases in these accounts. And on slide 58, this slide shows the continuation of the balance sheet analysis. And on slide 59, here's the income statement and additional information with the same company and amounts being used here as they were for the statement of cash flows under the indirect method. So we start with the same basic information. Slide 60. Again, the receipts from customers can be determined with the available information, revenues, and the beginning and ending balances of accounts receivable. Revenues plus any decrease in accounts receivable or minus any increase in accounts receivable will give us the cash receipts amount as shown on the slide. Again, the $517,000. And on slide 61, and the same with determining payments to suppliers with the information given. First, determining purchases from the information given on the inventory account, the beginning balance, cost of goods sold, and ending balance, and then using the purchases amount to determine the payments to suppliers or overall amount debited to accounts payable of $139,000. Again, the use of T accounts, very valuable here, and if any of you have any questions still about the use of T accounts, let me know. I can get the good old whiteboard out again and we can go through some more examples than what are being shown here on these slides. On slide 62, here's the formula for computing the cash payments to suppliers using both the inventory account information and the accounts payable account information regarding increases or decreases, as you can see. Cost of goods sold plus the increase in inventory or minus the decrease in inventory plus the decrease in accounts payable or minus the increase in accounts payable. On slide 63, cash payments for operating expenses need to be adjusted for any increase or decrease in prepaid expenses, as well as any increase or decrease in accrued expenses payable, an account that is separate and apart from accounts payable. In the example on this slide, the only impact is an increase to prepaid expenses of $4,000, which we saw previously when we were doing the indirect method, meaning that this amount needs to be added to the operating expenses to recognize that $4,000 more in payments were made than the expenses incurred. On slide 64, cash paid for interest is a debit to the interest payable account, as shown on this slide. On slide 65, same with cash paid for taxes, which is a debit to income taxes payable account. And on slide 66, so under the direct method, we start with the cash receipts from customers of $517,000, which was determined earlier as the revenues of $507,000 plus the decrease in accounts receivable of $10,000. We then subtract the cash payments from the major classifications: suppliers, operating expenses, interest expense, and income taxes. Note how the amounts shown for each of these is what was computed on the earlier slides using the formulas that were shown. And finally, notice how the net cash provided by operating activities of $172,000 just happens to equal what was computed for that same section using the indirect method. Just a different way of getting there. On slide 67, now moving to the investing and financing activities, we have the same items as before: the purchase of equipment for $25,000 and the sale of equipment for $4,000. On slide 68, going back to slide 57, there was an overall increase in equipment of $17,000 shown in the comparative balance sheet. This was comprised of the purchase of $25,000, which caused a debit to equipment, and the sale of equipment entry shown above, which credited equipment for $8,000, that is the book value at the time of sale. On slide 69, again, these major transactions shown on this slide are as they were in the indirect method example. Only the middle one, that is the building, involved cash, but the other, bonds payable exchange for land, must be reported because of its significance. And on slide 70, these transactions are recognizable from the indirect method example also. The issuance of common stock for $20,000 in cash, a financing activity, and the payment of a cash dividend of $29,000, financing also. Finally, here's the statement of cash flows under the direct method. The sections for investing and financing activities are essentially the same as under the indirect method. It's the operating activity section that is different, as the previous slides described. Excuse me. And on slide 72, again, we need to check to ensure that the change in the cash account reflected in the statement of cash flows equals the change shown on the comparative balance sheet. That is a $22,000 increase overall. And finally, on slide 73, we couldn't escape without good old IFRS. I think they provided about 7 or 8 slides here, and I'm boiling it down to just one on the key points regarding the statement of cash flows. Again, our coverage of IFRS is limited, not testable. This slide provides a good summary of the similarities between GAAP and IFRS regarding the statement of cash flows. And if you wish to delve into it further, by all means, knock yourself out, but we're not going to cover it any further in the class. With that, we'll conclude the presentation for Chapter 12.